All right, today we are breaking out the red pen and giving Extra Space Storage its Q4 report card. We're going to dive right into their latest earnings report and see exactly what grade they earned.
But before we get to the grades, here's a bigger question for you. How on earth can a company that just, stores our stuff tell us anything about the health of the entire economy? Well, believe it or not, it can, and that's the story we're unpacking today. So let's jump in. The company in the spotlight is Extra Space Storage. These guys are a huge player in the U.S. self-storage game. We're looking specifically at their performance in the fourth quarter of 2025 to see how they closed out the year. Okay, first things first. Let's just quickly touch on why these quarterly reports are such a big deal. You can think of them as a mandatory health check for any company that's traded on the stock market. Yeah, this is where a company has to open up its books and tell everyone, investors, analysts, you name it, how business is going. It covers how much money they made, if their grand strategy is actually working, and what they think is coming around the corner. It's a really crucial peek under the hood. So, with that said, let's get to the report card. How did Extra Space do on its big Q4 test? Well, the short answer is they passed with flying colors. The simplest way to put it is this. They delivered what's called a strong beat. And that means they didn't just meet what Wall Street expected them to do, they completely blew past those expectations.
Let's look at the actual numbers. When it comes to earnings per share, or EPS, the company came in at $2.08. The analysts were only expecting $2.03. That's a solid 5-cent beat right there.
But the revenue figures? Whoa, this is where it gets really impressive. They pulled in over $857 million. The expectation was only about $733 million. That's a beat of more than $124 million. That's not just a small win, folks. That is a massive upside surprise. So this table really just puts it all in perspective. On the two biggest metrics that everyone watches, EPS and revenue, Extra Space just knocked it out of the park. A total clean sweep. The numbers on a page are just the headline. What's the real story behind this pretty incredible growth? Let's dig into the bright spots.
You can really feel the confidence coming from the top. The company's CEO, Joe Margolis, basically said it all with this quote, right? He's expressing some serious optimism and hinting that they've got some real momentum building for the year ahead. Now, one of these super important numbers for a real estate company like this is something called Core FFO, which stands for Funds from Operations. It's basically a fancy way of measuring their cash flow. And theirs grew by a really healthy 2.5%. It's just another sign that the business's heart is beating strong. So the main takeaway here is that this strong quarter wasn't just a fluke. This success came from a whole bunch of different places. They had more customers moving in, they went out and strategically bought almost 70 new stores, and they even grew their side hustles, like their loan business and their massive property management platform. It's like a growth engine firing on all cylinders. But, and you knew there was a but coming, right? It wasn't all good news. The company is also pumping the brakes a little, signaling some caution. So what are these headwinds they're worried about? This is really the central puzzle of this whole report. If the end of 2025 was so fantastic, why isn't the forecast for 2026 way more optimistic? What's going on? What we've got here is a real tug-of-war. On one side, you have all that positive momentum we just talked about. But on the other side, you've got this surprisingly conservative forecast, and it's getting weighed down by some very specific challenges, like a lawsuit in New York and new pricing rules in LA. And yeah, their official guidance for the year ahead really shows that caution. Management is basically projecting that key metrics, like their revenue and that all-important FFO number, are going to be, well, pretty much flat. They are signaling very clearly that they see a slow, steady recovery, not some big boom. And the risks they're pointing to are very real. There's an active lawsuit in New York City. There are new regulations in Los Angeles that hit their ability to set prices. And then there's this subtle but really important point. People who use self-storage, they tend to stick around for a while. That means even if the company starts charging higher rates for new customers, it takes a long, long time for that extra cash to actually filter through and boost the company's overall revenue. Okay, so for our final section, let's zoom back out. With this whole mix of great results and a cautious outlook, what's the big picture for the self-storage industry? Well, according to the CEO himself, it all boils down to two key things that actually have nothing to do with storage units. It's about job growth and the supply of new facilities. Let's break that down. First, job growth. This is a massive driver for storage. Think about it. When people get new jobs, they often move, and when they move, they need a place to put their stuff. The company is betting big on its locations in the Sun Belt, where a lot of jobs are being created. And second, supply. It's simple, right? Fewer new competitors means less pressure to lower your prices. And they see the pace of new construction slowing down, which is definitely a good thing for an established player like them. So ultimately, it really does come down to a balancing act. On the inside, the company seems to be running a very tight ship. Their operations are strong, but on the outside, they're staring down a pretty uncertain economic road, one that's going to be shaped by those two big levers, jobs and supply. And that really leaves us with our final question. Extra space storage has proven it can execute like a champ. But in a slow, grinding economic recovery, is that internal strength going to be enough to fight off all those external headwinds? That is the big question that investors are going to be watching all year long.